What stood out to you amid all the selling?
Well, putting aside the fundamental factors, which we all know that I think is impacting markets, is you have these technical factors. For the first time in 10 years, you actually have tax loss selling. You have people worried about redemptions if you're running a mutual fund or a hedge fund. So there's a lot of people just raising cash just to meet redemptions. And then this time of the year, every human emotion gets exaggerated from a money manager standpoint. No one wants to miss around on the upside, and everyone wants to run out the door on the downside because December dollars are precious when a money manager is measured on a calendar basis. So those are the technical factors. But what you guys have been addressing on the fundamental reasons, there's certainly a lot of legitimate reasons for this selling.
Well, but Peter, talk to us about the U.S. economy itself, because we were just discussing that with Roger. In the last 3 months, and we've seen this U.S. equity market sell-off pick up pace, has the data and expectation for next year and even for the year after significantly worsened in the last 3 months?
Well, I think most of the weakness that we've been seeing has really been overseas, but I think it's naive not to think that that weakness overseas is going to merge into the U.S. At the same time, we've obviously seen softness in housing. We've seen a plateau in autos, which are two major contributors to the market, into the economy. But I've argued for a while that with the consumer really being the strength of the U.S. economy, what would impact eventually the U.S. consumer would be a potential decline in asset prices because we're so dependent on elevated asset prices. And when you look at the Fed's flow of funds statement, which was updated a few weeks ago for the third quarter, net worth as a percent of disposable income was at 700%. Never in our history have we been that expensive in terms of asset prices relative to the underlying economy. So then you throw in a trade war. Then you throw in a double tightening by the Fed with respect to rates and their balance sheet. And then obviously further uncertainty with the shutdown and all this. And it's sort of a toxic combination, high valuations and those other factors I mentioned.
Peter, I wanted to ask you about bonds and currencies, because this really does feel like this is an outsized equity move. I mean, yes, we have seen the 10-year yield go below 280, and we're starting to see some dollar weakness, though I'm not sure the kind of panic or the widespread selling that we're getting in stocks has been backed up by other markets. What's your take on that?
Well, it's interesting. I think, the dollar weakness, I think, is really directly attributed to the belief that the Fed is basically done. And I think you continue to see days like today, and that's perfectly clear. So that is a reason for the dollar weakness. The interesting thing about Treasuries is the 10-year yield at 280. It's still at 40 basis points this year. So bonds really have not been any flight to safety whatsoever. And I think that a lot of that has to do with inflation that's still hovering around 2. Obviously, it's going to recede from here, particularly because of energy prices, but massive amounts of Treasury supply because of rising debts and deficits. And that historical ballast of safety in Treasuries, it's a changed situation. And that when I talk about elevated asset values, not just in equities, it was in fixed income and a variety of other asset classes.
Yeah, I mean, I would just also point to gold, Wilfred, because if we were seeing this massive kind of panic flight to safety, you might see a bigger bid for gold, which is a traditional favorite safe haven. It's down for the year, and just in the last 3 months, it's up about 5%. It's still flat over the last 12 months.
But gold has traded better over the past week with the dollar topping out. So at least over the last couple of days, you are seeing that dollar weakness, that gold strength that I believe will continue into next year.
Peter, just quickly, some people talk about now the fact that we're not seeing a Fed put to support economic growth and or the markets, that we could see another form of fiscal policy stimulus. Clearly, we got one late last year. Anyway, what do you think is the likelihood of that, and whether or not that could offset some of the financial conditions tightening that we've seen?
Well, honestly, outside of something related to infrastructure, which I never really believe has a big multiplier effect anyway, I don't really think that that's a crutch people should be leaning on. I don't really know what's left. I mean, even if they do announce some infrastructure policy, that's something that plays out over multiple years. It's not something that's a quick fix. And unfortunately, we spent a lot of fiscal bullets